Comments made on the following paid commercial program are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time.
Welcome to the Money and Wealth Show. I'm Sterling Fox. On this week's program, tax tips with David Ingram, money commercials, and our special guest from Institutional Advisors, Bob Hoye.
It's all about money at the HouseStreet.com Money Expo 2010. They'll be talking money, making money, saving money, and protecting assets. See Garth Turner, Michael Levy, Ross Clark, David Skarica, David Smith, and David Morgan. Plus, visit with industry exhibitors. The HouseStreet.com Money Expo in Nanaimo, February 13th, Victoria, February 14th, Langley, February 27th, and Kelowna, March 13th. To attend free, pre-register now at HouseStreet.com. That's HOWE Street.com. It's all about money.
Welcome to the Money and Wealth Show. I'm Sterling Fox, and our special guest this week is the editor and chief investment strategist for Institutional Advisors. It's a real pleasure to welcome Bob Hoye to the show. Bob, good to see you.
Good to be with you, Sterling.
Thanks for joining us today.
It's a pleasure, especially in such interesting times in the financial markets.
Well, it is, and I want to take you back just a few weeks to the last piece you wrote in your newsletter at the end of December '09, in which you referred to the marketplace as an ongoing train wreck.
Yes.
I'd like you to elaborate on that a little bit, particularly as it applies now going forward into 2010. Any chance it's improving?
Not at all. And what you have here is that we've had a huge boom in the financial markets, and that includes certain activities in the credit markets. And this reached its climax in May and June of 2007, when the party was full on. And then the credit market started to change such that we then said, this is the beginning of the greatest train wreck in the history of credit. And then everything let loose. You had incidences such as the first one with Bear Stearns having a problem, and then Lehman, and then until you got the disaster of the fall of '08. So then we had a rebound. This is what you usually get in a crash. It'll rebound out with no assistance from any authorities at all, and it can usually run for about 6 months. That took us to September, and then you've had a very elevated stock market since then. Sentiment figures like the percent bulls are very high, the percent bears have been very low, and this brought us right out until the beginning of the year, and when the credit market started to turn again. You've had a party in the credit markets. The long corporate bond market, gosh, you could borrow money, the pros could borrow money at 0.5%. And in March, in the panic, the junk bond was yielding almost 42%. So is that a way to make money? Of course it is. And they kept running it. They kept bidding the price of the bond up, so it's now yielding around 11.75%. So that's what they call a carry trade, where you borrow money at 0.5% and buy an instrument that's going to pay you 11.75%. It's very fun. And that then got priced to the limit, and it began to change. So with the confidence in the market, the spread between the corporate bonds, in this case particular junk bonds, and the equivalent in treasuries began to narrow, which shows a lot of confidence. And then recently that all began to change. Actually, Sterling, we did have some technical work on the high yield corporate bond market, and it gave a signal that typically is a top for any price series, and the price has been coming down and the spreads have been widening. So that is underlying all the stories in the stock market. And without a positive credit market, the stock market can't run too far.
Now, I want to talk a little bit about interest rates, because you've opened that door for us here. How long can, from a consumer perspective particularly, Bob, how long can interest rates remain at these all-time historic lows, and when do you see the climb beginning?
Yeah, that's the low, of course, is at your short-term stuff, like 3-month treasury bills. They've been exceptionally low, but then they got exceptionally low during the 1930s. After the 1929 bubble, the 3-month Treasury bill in the U.S. went down to 0.08%, I mean, next to nothing. And that was when speculation had been diminished. So what you have here is that the decline in yields at the short end has been fostering fabulous speculation at the long end. And the long end's going to get destroyed. Short rates may not go up that much for U.S. Treasury bills or Government of Canada Treasury bills. But you can have a rise all the way from the midterm out to the long term, and that is what will shake up stock markets. But what you've also had, Sterling, is that it's like one party. They've been partying in, as we've been talking, in the corporate bond market. They've been partying in commodities, and they've been partying in stocks. And that is all against the US dollar going down. And recently, the clamor and the bear raid against the US dollar became really very agitated and excited, which of course is the sign that it's getting close to the bottom. And indeed, the US dollar index, which represents the dollar, it got down and concluding a pattern that leads to a significant rally. And now one of the worst things that could possibly happen to a policymaker, as well as the markets, is an outbreak of sound money. And as the dollar index goes up, it shows that the dollar is becoming sounder. And as we all know, the policymaker's recipe for anything is to depreciate the dollar. So why we think that this rising dollar can continue is that everybody got aboard the story that the US dollar was going to go down forever, the Federal Reserve was going to do it, and that then asset prices such as copper would go up forever, the Chinese would continue to buy. So that all got priced into the market, and then it has to relax, and it's been relaxing. So the worst thing that can happen in a speculative market is for the US dollar to strengthen, and we've been having that.
You're watching the Money and Wealth Show. Our special guest this week is Bob Hoye, and there's lots more to come after this.
Good afternoon. My name is Larry Ray. I'm the president and CEO of American Manganese, Inc., a company that's operating a manganese discovery at Artillery Peak, Arizona. Currently, we have a resource of about 11 billion pounds of manganese, which currently trades at $1.30 a pound. We have a 43101 economic evaluation that shows it to have very robust returns, with the potential of being the lowest cost producer in the world at 45 cents a pound. Our plans are to push this project further by drilling 191 drill holes in the next 6 months, entailing some 62,000 feet or 15 to 16,000 meters of drilling. American Manganese, Inc. currently trades under the ticker symbol AMY or AMY on the TSX Venture Exchange. If you'd like more information on us, visit us at our site americanmanganeseinc.com or give us a call at 604-531-9639.